Thank you very much for Sergey for the kind invitation. And I must credit Richard Olsen because he was the one who hired me when I made the transition from physics into finance without any experience in finance at the time. And the subject of my conversation is to reflect on the shortcomings of the existing financial market infrastructure and how we can move forward with securities, payments, and money. It would be ideal if we can quickly transition to what Richard Olsen presented to us last night as his vision for the future, but there are a few obstacles in the way, as I will mention. I am a member of the Future of Finance project of CFA Institute, where we convene workshops of experts to assess what the future of finance will bring. And we have identified scenarios that are listed there. They are listed here, and I will focus in particular on fintech disruption, but I will also touch upon the parallel worlds scenario, which is also quite interesting. It should be obvious to everybody here that finance is overripe for fintech disruption. Many other industries have seen radical transformation. Finance has seen very little, and parts of finance, including asset management, have seen even less. When we hold workshops, and we have held a number, and I have participated at least in 2 such workshops in Switzerland, including about 10 days ago, we always hold them under Chatham House rule. Do you know what is Chatham House rule? Well, for those of you who don't, Chatham House rule says that people can express themselves freely. You are allowed to use the information you gather from the discussion, but you cannot attribute the statements to anybody. So people are protected in their identity, and they can express themselves and contribute. And one of the statements that I heard already twice was from bankers saying, we love regulation. Regulation is a barrier to entry and protects our entrenched position. Incumbents are also protected by brand. Some brands are well recognized. And because of their entrenched position, they have also cultural obstacles to innovation. It's not finance is not, or traditional financial institution is not where innovation can take place. I have worked in banks, and I have worked at CERN, as Sergey mentioned, and the culture is very, very different. Now, I think that fintech is likely to impact the financial infrastructure before asset management. But why is finance overripe for disruption? Let us think about global payments. Revolut says back in the 80s, The quickest way to send money from London to New York was to physically take cash with you on a plane, just as in the movies. Surprisingly, still holds true today. But have you ever wondered why? Well, Revolut works. I have used it here last night. But if you make large payments, you cannot make it through Revolut. Recently, I was helping my wife, who's Japanese, trying to buy a property in Japan, and she was thinking of moving money from Switzerland into Japan. She was told in Japan that it will take at least 1 week. At least 1 week to have the money credited to her account. Although communication between banks is near real time, correspondent banks may take days, and they take even longer now because of compliance requirements. And if you have an enemy, you can wish to him or her to be involved with international wire transfers where something goes wrong. To reconcile it and get things straight, it may take weeks. The opaqueness of the correspondent banking network makes it so that settlement times and fees may be unpredictable. And it's not me saying it, it's the Fed itself. And with compliance, you have additional complications and the threat of being cut off from the network. It is for global payments. If you look at the architecture and distinguish between architecture and technology, the architecture was a significant innovation, but it was an innovation that was done 600 or 700 years ago. That was correspondent banking with the Medici. The Medici, well, one of the Medici was the Pope. They got a lot of money from France because faithful made offerings in churches. Florence needed to pay for wool they bought from France, and instead of carrying the money or the gold back and forth, they set up correspondent banks as they set them up somewhere else. They set up accounts with local financial institutions. And it's amazing to me that this very significant financial innovation 600 years ago still is the underpinning of the payment network, although the technology itself has changed. So let us move from payments to securities. Again, from the Federal Reserve Boards, intermediaries such as banks and broker-dealers are typically trusted by end users to store, maintain ownership record of, and transfer assets on their behalf. But can we trust them? Usually the system works, but there are examples, and actually one of them that I will just quote now has been pointed out to me by Sergey. There was a corporate event concerning Dole. Do you know Dole? There are very often you see Dole bananas. Well, Murdoch wanted to buy Dole, but according to some shareholders, he did not pay enough of a high price. There was a class action suit. He lost. The company was ordered to pay a certain compensation per share. The problem came when it came to counting the number of shares. They found 30% more outstanding shares than were on the books of the company. And that was perfectly explainable because with these corporate events, the company that back in the US of share ownership couldn't keep up. And so, you know what happened in the end? The court gave up. They thought that it was just too cumbersome to find out who the real shareholder at that particular point in time was, and they paid out to all of them, even if they had to pay out to more shareholders and more shares than they thought they had on the books. Now, when it comes to security creation, I can again point to my experience. Among other things, in recent times, I have tried to set up a certificate with a former colleague of mine from a bank to finance a company that does something in the real economy. Basically, they supply fuel to ships, but the ship owners pay late. They take 60 days or more to pay. It's a typical trade finance operation. The company needs the finance to finance the fuel. Everything is guaranteed by an insurance company, but the hiccup is that to set up such a certificate, it costs quite a substantial amount of money. Well, despite the fact that the rate charged is quite high, the interest rate that the end investors get is still quite high and attractive. It's 6.5% on the dollar. Actually, it costs the company more than 10% because the cost of creating the security is an horrible 3.5 to 4%. You'll tell me it's a small amount of money. The entire certificate is for 15 million, but still it's significant. Capital markets are inefficient. And I would submit to you that the true frontier for investment management is not using artificial intelligence to earn an extra basis point or two with a very sophisticated model. The true frontier for investment management is expanding the universe of investable assets. So we turn the conventional wisdom upside down. It's actually beta that matters most, not alpha. But to create efficient beta, you have to expand the universe of available securities and do it cheaply. Now, you can tell me you can do it through tokenization, but I think that the big challenge is to put together the new world with the existing world where the existing financial world where a lot of the money is. Now, having touched upon some of the, I would say, glaring limitation of current financial market infrastructure that show to us that the system is actually overripe for disruption, let us see what some of the solutions may be. I will not go into the technical details. I will discuss more some of the governance and trust aspects thereof. Even central bankers see now that distributed ledger technology could become a game changer. In fact, for payment, clearing, and settlement activities. But Benoit Coré, who's in charge of the Innovation Center at the BIS, puts a big if. If fintech companies can leverage the technology to meet demanding legal, operational, and risk management requirements. That's a big if. This is unprecedented technology that can lower back office costs, lower capital and collateral requirements, and also disintermediate non-core actors. Now, let us look, and these slides come from the BIS. Let us look at the forms of the architecture. Now we have a centralized ledger where we have a trusted institution, not always so trustworthy as we saw in the Dole case, but a trusted institution that needs to maintain the record for everybody. And so all parties must reconcile their local databases to the centralized ledger. Now, of course, the technology gives us distributed ledgers, which can come in two forms: permission distributed ledgers, where the information is distributed, but you still have access control, you still have a trusted central entity. And you'll have what probably Richard prefers, a permissionless distributed ledger, where you don't have any central entity, but the information is somewhat self-organizing through market participation. I spoke and shown the limitation of the existing payment system. Here is, and I will not go into the details, but here is a bit of how, through new technology, you could get the payment system working and operating in near real time. And this architecture would finally do away with the correspondent banking infrastructure that we have to rely on nowadays. As I mentioned already in the architectural scheme that I showed, you can have different potential configuration from distributed ledger technology arrangements. You can have one entity that maintains and updates the ledger, or you can have only approved entities that can use the services, and you can move all the way to your right, and any entity can use the service and play any role. What you see here is, in the first column, it's just an incremental change from today's financial market infrastructure. What you have at the end is very much like the Bitcoin. What are the issues? The issues with the last column is scalability, and we have here technical experts that can tell you much more about scalability than I know. And on the other hand, authorities like to be conservative and stay toward the first column because it's something that they are more familiar with, as we all see. There are many potential advantages of DLT for payment, clearing, and settlement. Reduction in complexity, because you don't have the need for all of this reconciliation. You don't have to reconcile the data of each institution with the central repository. Improving end-to-end processing speed, which has implication for the availability of assets and funds. And then, again, we said decreasing the need for reconciliation across multiple infrastructure. More transparency, and we already heard in the previous panel about immutability. Another advantage, I think, is distributed data management, and the improvement in network resilience that comes through distributed data management. But there are also challenges, and I can understand the challenges if I put myself in the shoes of somebody who has to decide to change to new architecture. I did it within a bank once, and it was a terrifying experience, a big bank. If one Friday you shut down, and you must be absolutely sure that you have come up with a new infrastructure as of Monday, it's really a very difficult concept. In fact, the problem is also lack of interoperability with existing processes and infrastructure. If you can kind of move from one system from one architecture to the next, you don't need a big bang, and that would be a lot easier. There is the question about settlement finality, because it's not so easily achieved immediately within the DLT technology. There are questions about the legal underpinning. The governance framework is a point that is made by central banks and regulators because they like a centralized governance. And there is again the question of scalability for large-scale applications. We shouldn't kid ourselves. Technology has its risk, and risks in terms of resilience, reliability, also risks in terms of security. I am not at all an expert of it, but what about quantum computing and threats from quantum computing to cryptography? Maybe you can ask the cryptography experts about it. But central bankers see a challenge, particularly concerning arrangements with a weak governance structure, which may not be able to react quickly enough to emerging security issues and threats. I put this as a question mark. It was not as a question mark in the BIS report, but it is a question mark here because I am not quite sure that, in fact, not having a governance structures like the central banks would like is actually such a bad thing. Then there are issues concerning privacy. Again, this is a statement coming from the BIS. DLT may also enhance transparency if information shared on the ledger is shared broadly. I find these statements of high concern to me. To libertarians, it would be a nightmare if this technology that started as very privacy guaranteeing becomes the tool to have the perfect audit trail on everything in the hands of governments that may not always be guided by the best of intentions. Now, concerning asset tokenization, that might be the answer to creating new securities. It has many advantages. The advantages of tokenized assets: immutable, accessible, divisible, cost-effective. But it has also challenges. You heard from the previous panel, there is the risk of fraud, misrepresentation. Who performs the due diligence on the underlying assets? And then the question of immutability. I would be very careful with immutability. Ownership of physical assets has time scales that can span centuries or millennia. If you go to countries like Italy or France, that are, especially my country of origin, Italy, is not known as being a well-organized country, it's quite the contrary. But if you go to real estate archives, in many cities, you can find records of ownership for 1,000 years. Those records of ownership were written by notaries on special paper with special ink, and they still survive today. France had a revolution, but records of real estate ownership remained. Are we sure that our blockchain and the entry in the blockchain today will be available without corruption, despite changes in technology, despite what the world will have to live through for 1,000 years? That is not a simple test to fulfill. If I am wrong, please tell me. But it's certainly a concern of mine. Before we move to my last topic, which is money and the future of money, I would like to share with you some announcements that you probably have picked up over the last year about all that's boiling up in central bank space concerning these new technologies. I think that they are looking at it with interest. For instance, now, since I am based in Switzerland, I'll tell you things that are relevant to Switzerland. The Swiss National Bank and the Bank of International Settlement have signed an operational agreement on an innovation hub center. They are thinking of using central bank money in the settlement of tokenized assets. So central banks, which are the bastion of the existing financial market infrastructure, are moving and thinking about the new technology. Now, I move back talking about the functions of money. You have already heard from Professor Yurishenko what were the functions of money. Actually, money should be a store of value, should be a medium of exchange, should be a unit of account. But it's very difficult to find any currency or anything that actually fulfills these functions and fulfills them well. Before going to that, we heard that gold is a good store of value. Over time, in fact, it's a good store of value. The only problem, it's very difficult to store gold. And it has costs. All fiat currencies, with the possible exception of the Swiss franc so far, have been relatively poor stores of values. Now, there are many forms of money. You already have seen the taxonomy of money in terms of the money flower. And that encompasses both the dimension of issuance and technology. Who issues the money? And you can expand, in a sense, the taxonomy of money, the money flower, into this table that gives you the form of privately issued money. In fact, privately issued money based on fiat systems, basically money issued by banks, and privately issued cryptocurrencies. I will not go into the full detail. I will concentrate more on basically the historical and governance underpinning. What is the present of money? The present of money is that we have a rather uncomfortable cohabitation among fiat currencies, gold, and cryptocurrencies. As a money manager, I talk to people who see that the increase in gold price may be signaling diminishing trust in fiat money and concern for systemic risk. Concerning cryptocurrencies, we have regulatory resistance, and even when it's allowed, if you operate in some businesses dealing with cryptocurrencies, you have difficulty opening bank accounts. Concerning money, we have a big elephant in the room, and the elephant in the room is the US dollar. Why is that? Well, you could ask Charles de Gaulle if he were still alive. Charles de Gaulle said that the US dollar status as a reserve currency and the principal medium for global trade confers an exorbitant privilege to the United States. Probably you don't know it, but Charles de Gaulle also, as soon basically as he could, he repatriated France gold to France. Why was France gold in the United States? It was in the United States because when Germany invaded France, France had gold everywhere in all small or mid-sized town because the franc was convertible into gold, and all the local branches of the French state bank, National Bank, needed to hold gold. So they hurried up, collected the gold, and brought it into the United States, but he repatriated it because he thought that gold was the real money. Now, the link between the dollar and the gold, as you know, is such that once upon a time, the dollar was as good as gold because there was a convertibility of of dollar into gold. But Roosevelt abolished the gold clause in 1933, and Nixon suspended gold convertibility of the dollar. And according to a Nobel Prize winner, who's not a particularly provocative person, this is actually at least a partial default. And I will quote his book later on. To come to more recent events, the USA have weaponized the US dollar. If you use the US dollar in any payment, anywhere, you are subject to the jurisdiction of US courts. A French company found that out when they paid a bribe in dollars in Africa. It did not involve the US. The bribe was not paid in the US. The company was not a US company. It was a French company. But the USA imposed and collected a fine on this particular company because the bribe was paid in dollars. Now, that would not come as a surprise to you if you had listened to the statements of Robert Morgenthau. You know Robert Morgenthau? Robert Morgenthau was US District Attorney in Manhattan. He was still active at age 90. He was still US District Attorney in Manhattan. And when Bank of Commerce and Commerce International went bankrupt, I believe it was in the 80s, he said, that's my business. I have jurisdiction over it. Why? Because they deal in US dollars, and 90% of US dollar trades are traded in my district in Manhattan. When Bank Wegelin decided that they would not need Bank Wegelin, it was an old bank in St. Gallen, Switzerland. They decided that they didn't need to comply with US securities laws because they didn't deal in US securities. They thought they were safe, but they forgot one thing. They were dealing in dollars, and they had a correspondent banking account in the US. The US District Attorney Office, the Office of the US District Attorney, although Robert Morgenthau was no longer there, knew that very well. And they seized the account that Bank Wegelin had at UBS in New York. And that was the end of Bank Wegelin after a 200 years history. So that is where we are with the dollar now. Now, let me discuss a bit one aspect of cryptocurrencies, like the Bitcoin, not the central bank cryptocurrencies, which is the fact that they are issued privately. In fact, private money is an old idea. It's motivated by the statement that you find in Adam Smith's The Wealth of Nations. Adam Smith was very skeptical of sovereigns issuing currency because he knew very well that history showed that sovereigns would try to find a way to diminish the value of their currency. They did it even when it was difficult to do it, when coins were in gold, and they have done it more successfully when the money was paper. To come to more recent times, the private issuance of currency was a pet idea of Nobel Prize winning economist Hayek of the Austrian School of Economics that wrote The Denationalization of Money in 1976. And Richard, if you think that your statements are provocative, read what Hayek wrote. I don't understand why he was not burned at the stake for what is written in that book. It's really, there are statements such as, history is largely inflation engineered by government. Competition would provide better money than would governments. And then about the conduct of monetary policy, he writes that monetary policy is neither desirable nor possible, And he says also a single monopolistic government agency can neither possess the information which should govern the supply of money, nor it would be usually in a position to act in that manner. I am not making comments, I am just reporting what Hayek wrote. So private money issuance is an old idea. Hayek would be very happy to see that technology now enables it. I told you that I would bring into the discussion a bit of history. My students are recommended, in fact required, to read this wonderful book. This book is by Rogoff, Reinhard and Rogoff, 800 years of folly. It is of financial folly. This time is different. And here it tells you, proving it with facts from history, that a lot of received ideas that we have are actually false. One of the most important statements that proven false is about government debt. You start in finance, you say, the risk-free asset is government debt. Let me tell you that this is just an assumption, a simplifying assumption. It's not at all well-grounded in empirical reality. It is much more true that motion is frictionless, which is an assumption in physics, although later on you can integrate friction as well, rather than applying it to central government debt, where nearly all governments have defaulted on their financial obligation in the past. Contrary to what you read even in finance books, it's not true that governments would even always print their own currency to meet their obligation. Governments have defaulted also on domestic debt. To discuss the future of money, we should differentiate governance from technology. Hayek made some good points for the denationalization of money, but that would be a dramatic change. There could be a bit of confusion. And as Professor Yurishenko stated this morning, sovereigns are not in a mood to give up seigniorage and the right to issue currency without a fight. The US will not give up the US dollar and the ability to use it to impose sanctions, to weaponize it without a fight. If you don't believe me, just listen to the congressional testimony during the Libra hearings, and congressman after congressman asked the question, what about our ability to impose sanctions? Of course, money can still be issued by the sovereign, as we heard this morning, in crypto form. Still, if private citizens get access to central bank crypto money, banks may be somewhat disintermediated, and also that will probably not happen without some fight. We started discussing trust and the fact that trust is very central in finance, whether it's created by a trustworthy institution or whether it's created by technology. We have a problem here. We are somewhat moving in terra incognita. I am old enough to remember when the world was the Cold War. There was US and there was the Soviet Union. And then we moved to the US being the leading country, and then now we are in an apolar world. So it's quite important to ask yourself, what is the existing financial order? How long will the US continue to be a world reserve currency? What about Bretton Woods institution? Are we risking somehow a fragmentation of the global financial system? That would be the parallel world scenario, which is one of the 4 scenarios that I mentioned at the beginning. Now we had also the question of the issue of the crises, the 2008 great financial crisis. Then that created the need to take action, and central bank took action in a very unprecedented way with unconventional monetary policy measures. To the extent that I ask myself whether the visible hand of central bankers has replaced Adam Smith's invisible hand, and creating impairment in price discovery. In my opinion, the answer is yes to both questions, with actually worrying consequences. Tongue-in-cheek, maybe that's not politically correct to say, but I will say it anyhow. The legacy of the Soviet Union lives on. The legacy of the Soviet Union lives on because we have embraced central planning. We have embraced central planning in what were the free market economies, because we got too used to the central banks, and when we look as financial analysts, we look at central bankers to try to understand what they are going to do. They have become stars, and I remember what a retired central banker, the former head of the central bank from Switzerland, told me once at a dinner. In the ideal world, a central banker should be a nameless bureaucrat that nobody interviews, nobody even knows his name. And we are very far away from this world, and I don't think that's the world that Adam Smith would have liked. Moreover, if we look at risk, when prices are formed by the sum of a sufficiently large number of independent random variables, central limit theorem applies, and we go toward the Gaussian distribution. We may have some tails, but as the number of actors become larger, risk conditions become milder and milder. Instead, when few influencers make the market, or we have price caps and floors, we create very fat tails, and we make the world very risky. And if you want to see that proven empirically in foreign exchange rates, you just have to look at the research by Olsen and Associates of quite a number of years ago. It's actually quite counterintuitive. So basically, it's, I think that you can give some mathematical meaning to the proposition that if you have many actors, none of which dominates, you actually have a much better risk profile than having a few important influencers. And now the question about central banks. They have become so big. They are very big as market players. can we trust them to be such large market players? Even the Swiss National Bank has a balance sheet that amounts to more than 100% of GDP. And trust is the cornerstone of finance. Now the question going forward is a permissionless world without a trusted third party a utopian approach that flies in the face of human history? Those are the words of a member of the ECB board. Or is the elusive promise of decentralized trust not so elusive after all? And trust is important because of the informational asymmetry. Before concluding, I would go on to say that going toward the future, we face obstacles. And again, I will not be politically correct here. One of the obstacles we face is the disingenuous use of compliance requirement to create barriers to entry. And I will not say much more on this slide, but it is something that I don't think can be ignored. My conclusion, the DLT carried a promise to make financial market infrastructure much more effective, with substantial improvement in transaction processing, expansion in the universe of investable assets through tokenization with large benefit to society. There are scalability, risk, and governance issues. The future of money depends on trust, whether it's better to have a decentralized or centralized trusted entities. It depends also on whether governments are willing to give up, even in part, a key privilege they had since money was introduced. Correct me if I'm wrong, but first money introduction was in the form of minted coins nearly 3,000 years ago. And guess who was producing the coins? It was governments. It was the kings that did that. However, geopolitical changes and unconventional monetary policy may erode the trust in centralized entities. But I don't think that big change will occur without crises and conflict. With this optimistic note, I end my presentation.
Yes, and we'll switch to the discussion right now. So thank you very much, Giuseppe. I would like to invite Richard also on stage. Giuseppe, please stay on stage as well. We just continue here.
Yes, I will.
So we have just maybe 30 minutes left, but we try to be productive and effective. And before, to begin with, Richard, I think you would rather agree with what Giuseppe just been presented, but is there something which you would strongly disagree in what you just seen?
First, I have to say thank you, Giuseppe. I mean, we know each other for so long, but it's fascinating how you present the history. Now, what I want to add to the story, and I think that's something which people have forgotten, is that the migration to new forms of currencies with modern technology can start with micro sums of transactions. So it's not that we have to kind of introduce it for the big transactions, but actually the new forms of payment can start with micro payments. And that adds an additional twist to the whole story.
Would you like to respond?
I think that's an excellent point. Maybe I thought, and I read wrong, the introduction of Libra, because I thought that that would be a wake-up call and that would be a beneficial event in the trajectory of getting non-government money out. It turns out that it seems to be the contrary, because governments could have probably have tolerated smaller actors, but they find it difficult to cope with such a big issuer.
So just regarding Libra and Facebook, it's fascinating. They just went about it the wrong way by just announcing it big and not having done the groundwork first. They created a lot of kind of pushback, and in the sense damaged the whole crypto movement a lot. Now, I want to add another point to your statement. That is, in the professional world, the intraday risk which pension funds, banks are exposed. Just to explain, so when you make a payment in the financial markets, settlement is not instantaneous, but delayed by 2 or more days. So if one of the players goes bankrupt, you suddenly have lost the money. So the problem is, you don't do an atomic swap. When you go to a bakery, the baker puts the bread on the shop counter, and you give the money, and it's atomic swap. But in financial markets, professional markets, you send your dollars, and maybe you receive your euros in this 2-day interval. And I think a big reason why the new technology could take off much faster is because this intertemporal risk. And I think in the next crisis, you'll see a lot of professional players suddenly jump on the bandwagon and say, I just want to have this more safe environment.
Yeah, actually, this is the biggest promise of the whole blockchain, like DLT technology, to disintermediate the market, to create the really immediate settlement, delivery versus payment, and also both maybe some central bank money, and to have the direct ownership. But Richard, I think those were also the assumptions when Lykke started, right? So to have a decentralized exchange, or like semi-decentralized exchange. But then later, like Lykke switched to the centralized regime. And when you compare the two, like, can you maybe think what are the lessons that you think they were learned, and what are the advantages of both regimes?
So, thanks to the whole experience, I learned a lot about structure of markets. So today, I would argue that we will not have just one model. Actually, you'll have all shades of marketplaces. That decentralized finance, kind of completely semi-decentralized and centralized. And they will fulfill different roles. So let me explain. In the centralized framework, you have the opportunity of much narrower spreads, because the market makers don't need to be physically able to deliver each quote which they have to give instantaneously, and that allows them to offer narrower spreads, and they have an information advantage. In the decentralized framework, they have to immediately deliver, so that adds to an additional charge. So I think the two models will live side by side, and also the intermediate one.
Another controversial point in the in those design comparison is the finality, right? So in the decentralized regime, you have finality, and every, let's say, trade is immediately settled, and you have the swap, and then it's final, right? So, and imagine now when there is the error or mistake, right? So in this decentralized world, in the decentralized exchange, this is a final. There is no way to correct the mistake. Because once the assets are swapped, then they're like kind of, this is final.
But there, at least from my point of view, I don't think that's a big issue. Because I still can have a legal claim against the other party. So I erroneously, kind of transferred the money, but I still have the claim. So we can still do an offsetting trade. And because in a financial market, you're actually most likely to further tradings in the future, you have an interest to maintain a good relationship. So I think finality is not that of a big issue that, as people kind of stated it.
I think that you don't have to take finality so literally. Actually, I think that it's very good to put together people that have technical competence with people who have experience in financial markets. I mean, you think, and the central banks tell you that transactions are final, but even if you do a futures transaction, even if it is confirmed now in the classical financial market, if there is an obvious error, there are ways to undo it. And as Richard says, if you are a market participant and you want to be trading again, you don't have the incentive to put up a fuss or a very lengthy legal battle because in the end you know that such things occur and you need a bit of a flexibility.
And with this said, when you say you can then reverse or negotiate the claim, it means that you have to have this know your counterparty rule. So you kind of, we are in an environment where we kind of, there's compliance already in place and we know our counterparties which we trade with, right? And what if the design is, the biggest promise is to have a global market, a permissionless market where anybody can enter, also somebody who wants to stay also anonymous, or with a country which you don't have any regulatory, interoperability, how do you yeah.
It's just a matter of price. So if you add additional risks which are associated, that has just an impact on the price which the counterparty has to pay. So I think, at least from my point of view, it's naive to think that people whom you don't know at all, you don't know from where they come, what the context of the trade is, that they should be able to trade at the same price as a counterparty which you know intimately.
And so, assume we have this ledger where we settle our trades. So maybe we use some on-chain trading, and it's either completely public or it's maybe semi-public. Then we have this full trail, right? So we see not just the trades, but also the counterparties. Currently, all the markets are pretty much anonymous. So when you see a trade log of an exchange, you don't normally see the IDs of the who traded. On the and this was your question about the transparency, how good and how bad it is. Will this be problematic for some of the players who might not actually want to trade on these new markets, or it's actually good because it's more transparent and we can see many more things there, for example, wash trading?
So first, I have to say that actually, even if you would know the identity, you know much less than you think, because when a party trades, because he buys and sells, you don't really know his exact position because there's a lot of netting which happens, and you don't know the equilibrium point of his position. So therefore, I think the transparency is actually de facto lower than one would expect.
I think that it's difficult to predict what would the impact would be. I think that we can take some lessons from what was done in the past, and typically in, again, the classical financial world, regulators have pushed for more transparency, with some good and bad effects. In illiquid markets, you need some measure of protection of the counterparty identity. Richard has a good point, that is that if it is a liquid security, maybe you cannot figure out even by having the counterparty to a trade, because he might be offsetting, you don't know what his position is. But if the security is relatively liquid, then it may become a concern. So I would actually leave it open and look at more empirical evidence before making a determination. And that depends very much on the characteristics of the security that's being traded. You can look at the government and corporate bond markets for some cues.
I think the point which you raise is very important, because actually we'll have to create a lot of different setups and be very ingenious for the different types of problems. And there is not kind of one brush works for everything.
It's a kind of an experiment which is going now in the markets. Basically, it is this comparison of the models. So you have decentralized exchanges like on Ethereum smart contracts, but then you also have centralized exchanges, cryptocurrency exchanges, and basically you see actually what wins, and the volumes on the DEXs, they stay really humble, like maybe several million per day, but the volumes on the centralized exchanges, they are like in billions per day. So it's 3 orders of magnitude more for the centralized exchanges. So the markets somehow prefer, though with all this, credit risk on the exchange, with other issues, they prefer to be on the centralized exchange, maybe because of the liquidity, or I don't know what.
So the first reason is the liquidity, but the second is, as soon as you offer leverage on a centralized exchange, actually the exposure which you have to the centralized exchange is much smaller. So the kind of counterparty risk is less important than we think.
In this regard, what we will see the kind of as the optimal design for the future, like ideal financial market, like kind of a hybrid between the centralized and decentralized exchange, and how this can be implemented.
So, I mean, for me, it's kind of, I clearly see the centralized exchange to play a very important role. But what I envisage is that the centralized exchange actually provides a price feed for the decentralized exchanges to operate. And we'll use this as a marketing strategy for the centralized exchange. So it actually is ready to undermine its own position for the purpose to establish its rates as the reference point.
The experience from, let us say, non-crypto financial assets has been that if you can look at the graph of the volumes, exchange volumes have increased quite significantly at the expense of over-the-counter volumes. That has been actually a consequence also of regulation.
Yes, but it might be a fluke, because I could anticipate that this kind of shift has happened due to the high-frequency traders who are abusing the wrong design of the matching engines of exchanges. So they kind of, because matching engines don't correctly price in the discovery value of bid and ask, and only are set up one-sided, high-frequency traders have been grabbing such a lot of market volume, pushing up the volumes.
That is indeed possible. I have not corrected for that effect, so I cannot answer that.
Actually, I'd like to even stress a bit more on the point of like, why do we need decentralized exchanges currently, I mean, in the crypto markets? My guess is that they are used because there is no KYC. Basically, you can enter into a trade through the smart contract without like showing your passport, because basically on other exchanges you need to show your passport. So here it may be the use case of various scenarios where you just don't want to reveal your identity to trade, and we come here the question of the KYC and know your counterparty. Do you think in the future of financial markets, when we have people having tokens and they want to exchange like token versus the other token, do we need KYC, or like to what extent?
So I am, and I know that I may be kind of the outsider, I actually believe that KYC ALM control will be the complete standard and pervasive, because you can hide the KYC information. Because anyway, when you want to trade on your wallet, you don't want someone else to trade. So I want to be identified with my connection where I'm trading. So this is why I think that will win. And also because then they can have full regulation and can offer such a lot of more services than those who are outside the normal domain. But that's mine.
Well, I think that for crypto assets to take hold, they have to integrate more and hopefully maybe take over the existing financial system. But in order to do that, you have to accept a certain amount of compliance and KYC. I would differentiate, however, between the need to establish the customer credentials for basically to make sure that that is really the customer, from all sorts of intrusive questions that are being asked now in the KYC process by some financial institutions. And I don't know where it's going to go, but I think that the information that's being asked from prospects and clients is far too much. There should be a principle of proportionality, that financial institutions find out only what is needed and not 10 times more.
Do you want to mention the Open VASP initiative, which is happening?
Yeah, you would like to tell a bit more about it?
So in Switzerland, the kind of FinMark kind of issued requirements that crypto banks, when they move crypto assets of customers back and forth, the recipient has to know from where it comes from. And this gives rise to an Open VASP protocol, which is being developed. And I find that is a very interesting development, because it's a protocol of how information about owner and where the money comes from is shared, but is shared in such a way that it's truly confidential to just the two parties who are involved. And that might be the kind of seed of a new SWIFT network. And if that is designed very well, this could become a huge success story and really kind of make cryptos, and with that also other forms of stable coins, which are traditional assets which are being tokenized, make this, bring this really mainstream.
Basically, I think it's a very important point here is that it's the power of the standards. When we have something standardized, that creates a huge sort of development in this area. Just another example of this standardization was the ERC20, right? So when there were different formats of the color coins issuance on the Bitcoin blockchain, but it never was the boom of the tokenization before the Ethereum ERC20 standards come into the light, and suddenly everybody started to issue those tokens according to the standard, and we've seen those ICO craze in 2017, where there was like thousands of tokens issued on Ethereum. And I slowly want to come into the question of the asset tokenization. So Giuseppe, you mentioned that it would be great to have a wide selection of assets. I mean, we can tokenize some illiquid assets in the world and make them divisible and tradable. This is the promise of tokenization. It's in this case, it's easy to issue the token because it's technically it's just maybe 5 minutes work to deploy a smart contract. But how to ensure the legal side of it, how to ensure that this asset really is, the rights to this asset are attached to this token. And I think this is a major, maybe a barrier for tokenization to be really global. Can you propose some ways to do it?
I think this is a problem that it's not new to tokenization. You have absolutely the same problem when you issue a security. There have been cases of security issuance, stock issuance, for companies that were just letterboxes without any operation. So you just need some sort, one needs to develop some sort of mechanism that what is represented in tokens is actually corresponds to reality. And I think that the problem is not worse for tokens than it is for traditional assets. In fact, in many ways, it's easier. But it's something that needs to be tackled.
So I believe, kind of a token is issued by the issuer. So the issuer is the counterparty who has to stand up for his promise. Now, I think the development will be much faster because as soon as a player has the right, he can start to issue tokens for all standard financial instruments. And now the exciting thing is, because you can buy that instrument in amounts of $1, $5, $6, you can check if he's good for his promise. So I think the technology and acceptance will spread much faster. And I do that based on our experience of Oanda. Because when we launched Oanda was in the middle of the dot-com bubble 2001. Actually, everything was a disaster at the company, everything around. But because people could settle trades of these small amounts, they had confirmation that it really works. So in that spirit, I think it could spread much faster.
And maybe final question from me, and then we can have some questions from the audience as well. Like in this future world with this DLT-based financial markets, what do you see the roles of the current market, participants like depositors, like CSDs, and the central counterparties? Do they ever have to be existing in this new world, or they can just be disintermediated by the blockchain, let's say?
So I have a very firm opinion. Originally, I just said, we don't need them anymore. But today, it's clear to me, as soon as I, in the form of Lykke, have a little bit of money, I'll immediately try to get a security settlement system license. But then use that license to empower blockchain and have it done through blockchain. But it's important from a strategic point of view that, for example, Lykke gets that license, that not someone can come in and say, you don't have the right license. So we don't need these organizations, but we need the license under which we'll operate the blockchain framework.
To be interoperable with the legislation. Mm-hmm.
I think that it will, the answer depends very much on which parts of the financial market infrastructure you are talking about. And I think that there are certain parts of the existing financial market infrastructure that are quite sound and have quite a bit of future ahead of them. How long, I don't know. But I think that not everybody will be disintermediated or disposed of at the same time, I think.
So just to explain, for me, they'll all be disintermediated. Just what we need is the license so that to the old world we can that we operate according to the old framework.
Mm-hmm.
This is the behavior of the nature, right? To mimicry.
Yes.
So we can take a few questions.
Hello, Tatiana Malachova, Bank of Russia. Thank you for your presentation. I have a question about fragmentation. Is this good or bad for financial market?
Oh, so what, sorry? Which?
Fragmentation.
Fragmentation.
Yes. Is this good or bad for financial market? I mean, cross-border financial services and financial stability in general.
I have a very definite point of view on that. I think fragmentation brings inefficiencies and it is bad. So in an ideal financial system is actually not fragmented. You could make a point where maybe by some measures, if the system is fragmented, maybe it's less prone to maybe a global crisis. For end users, a fragmented system is not good. Unfortunately, because of compliance and other requirements, it is actually more difficult and probably takes longer now to open a bank account or to open any type of financial relationship in another country that it took 40 years ago before the internet was born. If you, for instance, if you wanted to open an account in Switzerland, you could do that in the United States, you could do that in an hour. Try it now.
Hello, my name is Vlad. I have a question about HFT trading. So you were comparing traditional crypto exchanges like centralized exchanges and decentralized exchanges. And I have a question about your view of decentralized exchanges in future. Like, it's really difficult to make them fast, but decentralized exchanges are like P2P exchange for everybody. So maybe it's better to think of new way of trading, like not trading in bid and ask. Maybe it's better to change the whole logic of trading without queues, without fast trading, without trying to make orders in 1 millisecond and so on. Maybe if everything is changing this way, maybe we need to change trading itself.
So, at least from my point of view, there is a point, I think, which is not well understood. The closer you look at price movements in financial markets, the more ragged does it become. Now, why is that? That is an attractor for someone to take the other side. So there is a lot of value in that. And that is something very positive. Now, having said that, isn't it very easy to offer you an option-like product that you have 1 minute, 5 minutes, 6 minutes of time to execute on a specific price? So there is a lot of room for innovation. So I can easily accommodate the slowness of decentralized exchange framework with my pricing. It's not an issue. So the problem at this stage is, or this is what Lykke has been fighting with, just to get the technology up and running smoothly is just a little more time consuming than we first thought.
Yeah, 2 more questions maybe.
My name is Victor. So the question is about decentralization. You advocate for the decentralized, exchange or something, and the question is, how would you expect the government to fulfill its other obligations? Like, I don't know, if I have been cheated, I can resort to the law and then to the law enforcement in a centralized situation. But in a decentralized situation, where is the law? Where is the law enforcement? And, well, if, well, one can say that, okay, we have the smart contract and it is the law and, well, code is law. We all know how that played out for the DAO a few years ago, so that obviously doesn't work. Like, and saying there will be no more cheating is like saying, well, there will be no more wars, no more revolutions. Well, it doesn't work.
But it's easy to provide insurance coverage. I can offer you insurance to insure in case any trade goes wrong in a decentralized exchange. So I think there is a lot of room for innovation.
Okay, then the last question for the day.
My name is Simon Zab, Germany. Thank you. It was very interesting. I have the question to both speakers. How would you see the future in 10 years, 2030?
Well, you should go first. You are the expert on the future.
So for me, I mean, it's clear. It's an electronic barter society where everyone receives the means of payment that he wants to receive. So you can pay with what you want to pay, and the recipient receives what he wants to receive. That's point one. The second is that we have an infinitely polar world. Just like with the number of websites, there'll be a huge infinite number of different currencies and currency bases. And it's from there that the world will kind of move on.
Well, that is a very interesting view, probably likely to take more than 10 years, because if you think where we were 10 years ago, well, we were in 2010, and well, few things have happened since, but not so many. Perhaps, however, the pace of innovation may accelerate. And that would play in favor of your argument, because the adoption of new ideas is highly non-linear, which is a bit your argument that you were making, that you know 50 people and then you know. This is a very non-linear process. So it starts like a fire. It starts slowly and maybe it catches in a much bigger way later on. But I hope you are right and we don't take much longer than that.
So with this, let's thank the speakers and let's conclude the day. Thanks.